Private equity versus public investing. Which is better? What if I told you that the wealthiest 1% don't invest the way you do? They're not obsessing over stock charts or panic selling when the market dips. Instead, they're playing a different game, one with higher rewards but also higher risks. And if you're not paying attention, you could be leaving millions on the table. So today, we're diving deep into private equity versus public investing. Which is the better path to financial freedom? Stick around, because the answer might surprise you. The stakes. Why this matters. Most people grow up hearing one thing: invest in the stock market, buy index funds, and let compound interest do the work. Sounds simple, right? Until the market crashes, inflation eats away at your returns, or worse, you realize the ultra-wealthy are playing by an entirely different set of rules. Ever wonder how billionaires keep getting richer even when the stock market tanks? They're not just investing in public markets. They're in private equity, a world where deals happen behind closed doors, where businesses are bought, scaled, and sold for massive profits. But before you think, wait, isn't that just for rich people? Hold on, because opportunities are opening up, and you need to know how to play this game before it's too late. The comparison. Private equity versus public investing. 1. Accessibility and liquidity. Public stocks? Easy. Buy, sell, cash out. You can be in and out of a trade in seconds. Private equity? Not so much. Once your money's in, it could be locked up for years. So why do the wealthy love it? Because the best opportunities don't exist in plain sight. Private deals often yield far higher returns than the stock market, if you know what you're doing. Second, risk versus reward. Investing in stocks feels safe because, well, they're regulated. You can research Apple, Tesla, or Amazon with a few clicks. But in private equity, there's less transparency and higher risk, but also bigger rewards. Here's the kicker. While stocks might return 8 to 10% annually, private equity can generate 20%. 30%, or even 100% plus returns. Of course, that's if you make the right moves. Make the wrong ones. You could lose everything. 3. Control over your investment. When you buy a stock, you're at the mercy of the company's leadership. One bad earnings report, and your investment tanks. But private equity investors, they take control. They buy businesses, improve them, and create value, rather than just hoping the stock price goes up. 4. Barriers to entry and who can invest. Here's the part that frustrates most people. Private equity is usually off limits unless you're wealthy. Most deals require investors to be accredited, meaning you need a net worth of $1 million or an income of at least $200,000 per year. But here's the good news. New platforms are breaking these barriers, allowing everyday investors to access private deals without needing millions. The conclusion: which is better for you? So, private equity or public investing, which one wins? Well, it depends on your goals. If you want liquidity, transparency, and easy access, public investing is the way to go. But if you're looking for higher returns, control, and playing the game like the ultra-wealthy, private equity is a powerful option, if you can get in. So if you found this valuable, hit that like button, subscribe, and turn on notifications. Because in the next video, I'll show you how to invest like the wealthy, even if you're starting from scratch. See you there.